Jerome Powell and the Federal Reserve are gearing up to crash the U.S. housing market in 2023 because according to the Federal Reserve Bank of Dallas, there is now a threat of a global housing crisis amid these rising rates. They go on to show that the U.S. home price to income ratio is at the highest levels of all time right now, and that it will necessitate a 20% decline in home prices to bring the U.S. housing market in line with fundamentals. And the way that the Fed is going to achieve this decline in home prices is through increasing mortgage rates. And right now, the mortgage rates in America are absolutely skyrocketing, with the average 30-year fixed mortgage rate increasing from 6% 1 month ago to over 7% today, according to Mortgage News Daily. And if a 7% mortgage rate sounds high to you, it is high, because that mortgage rate combined with how high home prices are today means that the average American to purchase a house would need to spend over $30,000 a year on their mortgage interest, property taxes, and insurance. Now that $30,000 a year number to buy a house is a big problem for the typical American household. That's because the typical American household, everyone, earns about $75,000 a year. So in order for Americans to participate in today's housing market, they need to spend over 40% of their income on their home ownership costs when the long run average is 27%. And when you see those figures, you realize no wonder we're having a mortgage collapse right now. No wonder mortgage demand from home buyers just dropped to a 28-year low. And this collapse in mortgage demand, which I talked about in a video last week, is coming right at the same time that we're seeing a big increase in mortgage defaults of existing homeowners, because the Mortgage Bankers Association just reported that mortgage delinquencies increased in the fourth quarter of 2022. In particular, they noted that the FHA delinquency rate increased 209 basis points to over 10%. And a 10% default rate on FHA loans is crazy. It's going to mean that we're going to see a big increase in foreclosures in the second half of 2023, and that increase in foreclosures is going to add inventory to the U.S. housing market and bring home prices down by even more, which is good news if you're a home buyer, but it's bad news for the economy overall, because the default rate on FHA loans, which are those kind of first-time home buyer loans where people only put 3 to 5% down, that typically is a canary in the coal mine for the U.S. economy. And when we see those FHA defaults go up, it's a sign that the odds of a recession are increasing significantly. We're also seeing the default rate increase on other types of loans throughout the economy, particularly on car loans. For instance, Axios just reported that low-income households are falling behind on their car bills, and you can see this through a massive increase in the subprime auto delinquency rate, which is now 6%. That's the highest level of all time, even higher than it was at the peak of the Great Recession in the late 2000s. And so in case you're someone who thought that maybe the US economy wasn't heading into a recession, that everything was fine, I would encourage you to look closer at the data, because the leading indicators of the economy suggest that a recession is already either here or is going to be here sometime in 2023. And the longer that inflation remains an issue in the US economy, the worse this recession is likely to be. Because right now, the inflation readings in early 2023, they don't look good. Right now, the annual inflation rate is still 6.3%. Yes, that's down from a peak of 9% over the summer, but it's still basically the highest level in the last 40 years and way higher still than the Fed's 2% inflation target. And so long as that inflation number stays well above 2%, Jerome Powell and the Fed, they're going to keep hiking. They're going to inflict pain on the U.S. consumer in an effort to rein in consumer spending and to cause inflation to go down. And the one group that's really been hit hard by these interest rate hikes are investors, particularly real estate investors. Because these big Wall Street funds that buy real estate, they historically bought real estate because it offered a better return than buying other types of bonds like U.S. Treasuries. Which you can see exemplified by the fact that the cap rate for investors who own rental properties was always higher than the 1-year treasury yield going back 4 or 5 years, which meant that the investors would earn a premium by buying real estate and do better than buying bonds. But folks, pay attention now to the top right of this graph. The 1-year treasury yield, because of these Powell interest rate hikes, has surged almost to 5%, which is now higher than the cap rate or the profit an investor gets from owning real estate. So just think about that for a second, everyone. everyone. Why would these Wall Street investors, or any real estate investor for that matter, buy a house and rent it out for a 4.7% return when they could just sit on their couch and buy a 1-year risk-free US Treasury for almost 5%? Well, they wouldn't. And that's why we saw a massive collapse in investor demand at the second half of 2022, and why I think we're going to continue to see a collapse in investor demand throughout 2023, because it just doesn't make sense to own real estate. It's a bad investment right now given where interest rates are. But the thing you gotta understand about investors, everyone, whether they be real estate investors or stock investors, is that many of them are still in denial. Even though the writing's on the wall, even though it doesn't make sense to buy real estate or stocks given where interest rates are, many of them are still doing it because they're just not ready to give it up. And understand that this is normal. In the psychology of a market cycle, there is a denial stage that we're in right now where people think that their investments are good, but eventually this denial will give way to panic and then capitulation. And that will likely occur when the US job market gets worse. Right now, the unemployment rate is still at a record low 3.4%. And this record low unemployment rate is giving some false confidence to a lot of investors out there that this is just no big deal and things will be okay. But folks, we all know what's going to happen with the unemployment rate. I mean, you're seeing it in the layoffs right now. I mean, let's just take a look at some of the companies that announced layoffs in just the last month. We're talking Twitter, Roomba, Disney, Zoom, Dell, HubSpot, PayPal, IBM, 3M, Spotify, Google, Microsoft, Amazon, Coinbase, DirecTV, Salesforce, Vimeo, Goldman Sachs. These are some big major companies cutting people, and these layoffs are showing no signs of slowing, especially in the tech sector, where over the first 2 months of 2023, we've had 122,000 layoffs, which is 4 times the amount that occurred 1 year ago in the second quarter of 2022, and is also more than occurred in the second quarter of 2020 when the pandemic hit. And so what I think is going to happen in the US economy this year is that these layoffs, which are heavily white-collar, high-wage layoffs, they're going to intersect this year with a slowdown in general consumer spending, because the average consumer in America, they're in rough shape right now. They do not have much money to spend. We know this because the personal savings rate is near a record low 4.7%. Over the last 60 years, it's averaged about 9%. It's 4.7% today. And why is that the case? Well, because the inflation over the last 2 to 3 years went up much faster than people's income and wages. So people are saving less, and they're actually having to resort to debt now to sustain their spending. A big trend in the US economy among consumers has been using credit card debt and consumer loans like buy now, pay later to fund the spending and keep the spending going. Specifically, outstanding credit card debt in America is now nearly $1 trillion. That's $958 billion. That's significantly higher than it was during the pandemic, and that's actually by far the highest level of all time in terms of credit card debt. And ultimately, this debt binge can sustain the economy for a little while, but eventually it's going to run out of steam. And when it runs out of steam, that's going to mean a lot of businesses are going to close down. It's going to mean that the unemployment rate goes up, and that all the things I've been talking about in this video about, the Fed-induced crash are going to get even worse. So how can you prepare for this downturn? Is there anything you can do in terms of investing or budgeting that's going to help you weather the storm? And I think number one, everyone, is to cut extraneous expenses. This is something I have been doing over the last 1 to 2 months. It's actually amazing when I went through my Reventure consulting business expense book, how many things I was spending money on that I didn't use. I cut those things, which is going to help my bottom line, both for my business and me personally. But then number two, everyone, one thing I'm now doing is I'm investing in treasury yields, in bonds. That 1-year treasury yield I talked about before, yeah, it's close to 5%. And I think it's actually even above 5% right now, which is a pretty good return. As I said, it's better than you can get by buying real estate. And a treasury yield, it's as close to a risk-free asset as there is. But of course, it's not totally risk-free, as there's now discussion that the US might default on its debt in the summer or early fall if Congress doesn't raise the debt ceiling. So not even a treasury is perfectly safe, everyone. If the US defaults on its debt, they probably wouldn't pay interest on certain treasury bills, and maybe you wouldn't get your money. So ultimately, nothing is completely safe. And that's why the main thing I'm actually doing is just saving as much cash as possible, stockpiling my cash position so I can take advantage of the opportunities that are going to come about throughout this recession and housing downturn and stock market crash. And while the common perception is that holding cash isn't good during periods of inflation, I actually think this period of inflation is going to end up resulting in a deflationary crash when all is said and done, because I don't see how the US consumer and the US economy can support today's prices for much longer. And lastly, everyone, I want to hear from you guys out there about what you're seeing in the economy. Are you seeing signs of a recession in your day-to-day life, and what are you doing to prepare for it? Let me know in the comments section below. I'm going to be going through these comments and responding to some of them